Hi all. Welcome to Paci Sprinkles. We're essentially doing this session on decoding cash flow statement for small businesses. This was one of the things that people had requested us to do. So we were expecting a lot more attendance. We usually do on a wide range of topics. So I'm Abdul Ghafoor Fazal. I'm essentially the founder of Paci.ai, Cosmea Tech, and was also with EY for quite a bit of time. So just diving straight in, just getting into introductions. Essentially, Paci is an AI-powered virtual finance manager for micro businesses. We're a software with a service that comes with an accountant. The mission is to simplify finance from invoicing to payments for these micro businesses. We aim to be like a WhatsApp of finance management. That means simple, efficient, and gets the job done. You're here as part of our learning community that's dedicated to educating business owners on topics from financial literacy to marketing fundamentals. We started this July and have already covered topics such as finance management for micro businesses, business plan in 1 hour, prepare a simple budget in 1 hour, and so on and so forth. And the next focus is essentially going to be on marketing, growth hacking. So if there's somebody who is an expert in something like this, quite happy to do a session collaborated with with somebody from the group. Yeah. Moving on, we also create a lot of fun content on financial literacy, but like just seeing two examples of something that we've created. So the agenda is basically what's a cash flow statement, why is it important? There's a different kinds of methods in which you can go ahead and see cash flow, what's included in a cash flow statement, and what do they essentially mean, right? So a cash flow statement at its core, in the most simplest way, it just measures what your business generates in cash. Is it enough to essentially keep, the lights on, right? A more profitable, statement explanation would be that it paints a picture of on how the operations are running, where the money comes from, where the money is being spent. Also known as a cash flow statement, it essentially helps, different stakeholders determine what's the status, right? Whether, let's say, if you're a debtor, that's banks XYZ, it gives you an idea of the liquidity. If you're an investor, whether it's on like, you're on solid ground. Moving on, there's something very profound somebody said with regard to cash. I just want to play that.
Revenue is vanity, profit is sanity, right? And cash is reality. Oh, I think that punch.
Yeah, so this is again me. I'm quite passionate about monitoring cash flow, and I always say that you know revenue is vanity, profit is sanity, and cash flow is all about reality, right? And that's essentially how you keep your lights on.
Revenue is vanity.
So why do small businesses need to understand cash flow? I think everybody, what happens is what you can call as a trifecta of your financial statements. People, everybody understands P&L statement or income statement. Most people don't look at a cash flow statement or their balance sheets, and this is, I think, rife among small businesses. It's the focus is there's multiple reasons for this. One is there's a lack of understanding, and second, P&L is just such a simple concept to grasp in that and get fooled by. So essentially, that's what happens, right? And so why is it important? As I was saying, don't run out of cash. It's essentially the bridge between P&L and your balance sheet, right? It's not the P&L is just showing you how well the operations are running, and the balance sheet is essentially telling you what's the standing of your business at that particular point of time, whether there's leverage, are you over leveraged, and all that. You get that from balance sheet, and the bridge is essentially your cash flow statement. Gulnar, feel free to stop me if you feel that, I'm going quickly or, is there
No.
something else that
It would be
you
great
talk
if
about?
the attendees could just answer this poll that you see on your screen, just so we know if whoever's here has the practice of looking at it. Only one person has, again.
And I think, yeah.
Right. Yeah. So I think it's either monthly or there are people, I mean, someone who only does it when required. So, yeah, I think.
I think this is a very, very smart audience. They do look at it on a monthly basis.
Yeah.
So congrats to you guys on this. I mean, I'm not sure whether Gulnar is, made a poll on this. Whether you understand, accrual accounting and its importance, right? I mean, just some of them don't, and then it's just a question. We don't need to do a poll
So
on
I
this.
actually wanted someone to speak up rather than click on the poll if anybody knows the term accrual accounting. You guys, we would love it if we could hear your thoughts as well.
Some of the expenses we are not paying at the time of exact requirement, like depreciation, like the gratuity. We are just accruing at the P&L. So this can impact at the end of the year of our cash flow, not every monthly basis. So we need to look at this also accordingly.
Perfect.
Various,
Yeah.
yeah.
Yeah, I mean, thanks, Kapil. So essentially, you're right. Accrual, a cash-based accounting is when you just capture, or you record the event as it occurs, right? When you sell it, you receive cash, you record it as revenue, you disburse an expense, you capture. Now, there's some significant issues of monitoring your cash flow as well as your financials on the basis of something like this, right? And just giving some illustrations of, what could happen, right? So you do example as a credit sale, you do a credit sale, what's the situation? Business makes the sale on credit. Effect on profit is that it is recorded as revenue immediately, it boosts profits, right? Effect on cash flow is that, the cash is not received until later when the customer pays the invoice, right? So that means there's no effect, right? Result is business shows a profit, but the cash flow is negative or neutral, or, because money hasn't been received yet. Example could be a small business sells something for 10,000 on credit. They've record the sale as profit, but then since the customer hasn't paid, there's no cash inflow. And especially this is rife in various industries. I operate another startup within the construction tech industry, and recently we collected a payment for a work that we did in March 2022, right? So that's recorded as profit. But if you can see, it spans so many years, right? Now, some people would practice that as, keeping that as a provision for bad debts and all of that. But we've got a relationship with this client, and we knew that, that payment is just going to come, right? Another case is similarly to what Kapil said is depreciation. It is essentially just an accounting expense. There's no cash outlay. The purpose of, keeping something for depreciation is essentially that when that replacement occurs, you've got cash to tide over those things. So similarly, as I was mentioning in the earlier case, cash flow is unaffected because no actual cash is spent on depreciation. Business shows lower profit due to depreciation, but the cash flow remains healthy, right? And so just another example, you purchase an equipment for 50K. Let's say it's like fixed furnitures and fixtures. It's probably got a lifetime of 10 years, and then you depreciate it 5,000 each year, right? But the cash flow is not affected since the cash was spent upfront. Some other instances where something like this could occur is loan repayments, inventory purchases, prepaid expenses, capital expenditure, and prepayments, right? And these examples essentially highlight the timing differences between a cash transactions and accounting rules that can lead to significant differences between reported profits and actual cash flow. Understanding this is critical for managing business liquidity, cash out shortages, right? A good example is that, let's say you go ahead and recruit on the basis of just your P&L, right? Let's say it's a similar engineering firm that I was talking about earlier. Let's say I'm looking at, my team is full of work, we've got an entire pipeline of work. I go ahead and recruit without, we look at the P&L statement, you're well in the green, your profits, but then if you don't look at the cash flow, this thing, you would go ahead and recruit people, and then that would lead to a shortfall on salaries, right? So certain dangers can be prevented by looking at this. Again, so what are how is a cash flow statement produced? What are the different types of ways that you can go ahead and produce a cash flow statement? There's a direct method. It's essentially what I mentioned. You just record cash when it comes in, expense when it is when it's disbursed. Common line items using this method could be customer receipts, payments to suppliers, interest, dividends, and income tax payments, right? The best practice, what you see in all softwares and everything, is essentially accrual-based accounting. That means revenue expenses are counted when they are incurred rather than when the money actually changes hands, right? And so what the accountant would do is essentially, I don't know whether you could use the term de-accrue, right? You would add back certain non-cash expenses, and then you would deduct certain expenses, right, to arrive at what the real cash flow position is, right? The classic example could be depreciation, as we've mentioned before. You just add back depreciation because it's not really an actual cash outlay. The key components of a cash flow statement, an indirect method, is your cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities, right? Each of these components are important for a business. Again, if anybody wants to say something, please put up your hands, because I'm kind of using the screen, and so can't really see what people are thinking, or I mean, if anybody wants to talk specifically. Yeah, so this is just like a sample that I pulled out from the internet, and then it just shows like your net earnings. You add back the depreciations, right? And you add back accounts receivable decrease, increase in accounts payable, and you subtract from cash essentially if you've got inventory, right? So inventory, essentially, it goes into your assets. So that's the reason why you subtract from it. So again, so just going back to the first component, which is your cash flow from operating activities. Operating activities represent the money that your organization received or spent to keep your business running, right? This includes your revenue from sales. It's essentially a starting point for your cash flow statement. It is, if we are using the indirect method, which is best practice, your net income would be displayed like I've just put up a sample just thing on the right hand side, right? For the reporting period, you've got a cash flow of 19,600. Then you would make certain adjustments, right? Let's say a credit card payment. A credit card payment hasn't become due, right? Because there's a certain credit period, and you will spend 5,000 for payroll, or you owe a reimbursement which will come, right? And once you do all of these adjustments, you would arrive at net cash from operating activities. That's essentially what it is. The next one is cash flow from investing activities. These are investing activities categories within a cash flow. Sometimes you call them as the capital expenditure section. It records the cost of investments made by a company. These insights can essentially help you or your investors, gauge the overall impact of your company's investments at a certain point of time. Like our focus is on micro businesses, so that's why you've gone ahead and you purchased a system, you've spent some money on it, and that kind of is deducted from it, right? And yeah, so I've again given various examples of this, which is like buying and selling of physical assets, such as a computer, software, office equipment, office spaces. In case you you have a subsidiary business that you want to sell, all of this would come into this. The next component or the final component is essentially anything to deal with cash involved with borrowing money, managing debt, raising capital, right? So this would be things such as you've received loans from banks, you're issuing or buying equity in your company, you're paying dividends to your shareholders. All of this would end up in your financing activities. And that's, again, another example of something that we've shown here for that. Again, any specific questions, anything that anybody wanted to ask?
I would suggest if anyone has any questions specific to their business, if you are stuck somewhere with regards to not understanding any of these components, please feel free to ask, so that we want this to be an interactive section as well. So if you have any question that's bugging you, you want to clear it out, please go ahead and ask.
Again, some best practices: monitor cash regularly, encourage businesses to review, monthly. But, I've seen from the audience that they review it monthly, right? Manage receivables, payables, build cash reserves, use technology such as us. And so these are some best practices. There are other softwares too that you can use, but yeah.
I actually have a right now.
Yeah,
I'm sorry.
please. Yeah.
If all of you could just answer if you use a software to prepare your cash flow at the moment. I think we have more people who do this manually. Fazal, do you have anything to add here about them, whether it's better to use software or do it manually?
I mean, it's definitely, I mean, you could do it manually. But it's quite difficult to do this manually because of how it interacts with various other statements, essentially. So, but I am surprised with the number. But kudos to all of you guys who are doing this manually. I'm very curious. When you buy an asset, how are you capturing this manually, and how is that? How that's done. So we are planning to have a face-to-face learning session, and maybe we could go through this, a couple of examples of this and how this is. Ram, hi. Hello.
Hi, Fazal. Yeah.
Any comments on preparing this manually?
Manual cash flow means basically we have a less transactions mean there is no much complication and all means we can prepare it manually. But I would suggest using software is better practice sometimes.
So how would they capture if they've got like something like an accounts receivable, right? How would they how would that get captured, right? If
Yeah,
you're
that's
doing
what
it manually.
exactly. So the best practice is using an accounting software or a tool, basically any tool, so that see there won't be any missing transactions and all won't be there. So we'll get the
Now,
exact
then how do
closing
you
balance
add back
also.
how do you add back depreciation? How do you there's a number of balance sheet items, right? When you do this manually, which it gets a little difficult for that.
Yes, exactly. So, basically, in cash flow statement, in investing activities and operating activities, most of the balance sheet numbers only will come to the cash flow statement, right? So, manually means, yeah, as I said, if we have very less transactions, we can prepare it. But if we have quite more complicated, for example, if we have fixed asset and all means, if it is a accrual based accounting also means we have to use the software for that.
Okay. So this again, guys, this is a lot of this which we had mentioned, that it's important to look at your finances in line with all of these three statements. Only then do you get the right picture. But I understand when you're starting off, most important thing is to do sales and marketing and all of that, right? And then so this was a quick session. We had taken this session based on feedback that we received from our community. Most of our sessions are a lot more broader topics, but then people wanted to dive in. I think a couple of the topics, like I mentioned earlier, was how to prepare a business plan, right? How to prepare different types of budgets. And I think the next one that we are doing is essentially on, if you're starting a business, don't just dive in what are the different methods that you can go ahead and validate it, right? So we're going to give you like a sequential flow. What I've understood is a lot of people find taxes, financial statements, and other things boring. So we've gonna change that up a little bit, because I think for the budgeting one, we've had a lot more people sign up. So we're going to keep that in mind. And I think the next one we're going to keep on business validation. What are the different hacks, tricks that you can do, whether it's surveys, running ads before you launch the business and all of that, right? So that's it, guys. Thank you. This is, a super short session. I've just put in a link to our learning group as well as our Instagram page out here. If any of you guys want to join or follow us, we do around 2 to 3 webinars each month on different topics, from explaining payment gateways to explaining payment gateways, or explaining different topics, like I call it topic in a minute, such as what is cost of goods sold, what happens when you send what's IBAN, what is depreciation, and so on and so forth. Yeah. Thank you all. I'm just going to leave this here for a second, and
While
that's
that's
our
happening, I just want to stress on how much I want you guys to ask questions, because that will just increase your knowledge and help you understand better, because we understand, even though it's a short topic, it could get a little confusing if you're trying to relate it to your business. So please ask away. And of course, you can ask in sprinkles as well, but yeah, would love to have a conversation. Okay, thank you everyone for being here, for attending the webinar. We hope we helped you all clear some stuff about cash flow, and feel free to reach out to us in case of any questions or concerns or doubts in the group, or individually to us. Like, our details are available on the group. Thank you so much. Hope you guys have a lovely evening.